Hi,
Hello, Rohini. Good evening to you.
Hi, Rohini.
good evening.
Hey, hi.
Nice to have you.
Since we now have both of you, we'll kick off Rohini and Robin. Uh, warm welcome to all our viewers and Rohini and to Robin, to both of you as well. And, glad to have everyone on board for, this week's edition of Startup Buzz. The context that I would like to add before handing it to the two of you is, this is actually, our second session with the two of you. And I think this speaks volumes for the way this startup buzz has shaped up ever since we started it off in the month of May this year. So, for all those you who've logged in this time, who may not have been part of the earlier one, I must say that, our first session was in June, on 19th June. And at that time, it was called SHA Demystified, what every founder must know, before signing up. And, on public demand, if I may say so, we now have this session, which is about unlocking the three most critical clauses in the shareholder agreement. So we're all super excited, and I'm sure there's a lot for our viewers to sort of pick up from this discussion. Robin and Rohini, over the two of you.
Thank you, Ravi. Thank you, Rohini. It's lovely to have you today with us. Um, Ravi just said we are together again due to public demand. The last one, you did a fantastic job. You clarified a lot of issues regarding shareholders agreement. Before I begin with what we are supposed to do, a brief background of Rohini. Rohini Nair, a very well-known lawyer in the country. She's the partner for a very famous law firm called A&B Legal. This is a company, this is a firm which does investment funds and commercial practices. It's a global firm. She does advising to a lot of corporates regarding M&As, acquisitions, investments, and so on and so forth. She's a lawyer. She is a very popular speaker. She's speaking almost everywhere. But most importantly, she's also a trained Bharatanatyam dancer. I sometimes wonder, Rohini, that how could you do the dancing and the tough legal work which you do? But thank you, ladies and gentlemen. Over to Rohini very soon. She would be sharing with us today, over the next 45 minutes or so, what are the three most important aspects to be looked at and addressed for a shareholders agreement? I would start by saying and requesting Rohini, while we are just going to discuss three most important aspects, but before that, for some of the viewers who would have joined for the first time and may not have joined the first one, if you could quickly explain in 2-3 minutes what is a shareholders agreement and why is it important at all for all of us sometimes to lose our sleep over. Over to you, Rohini.
Hi, hello everyone. Good evening. Thank you, Ravi. Thank you, Robin, once again. So I think what I understand you want me to probably walk through is what an SHA is. Is that correct? A brief
Yes, if you could explain what is a shareholders agreement per se and why is it an important document?
Right. So each time that a founder seeks investment, be it an angel investor, be it friends and family, or be it any institutional investor, be it PVC firm, the idea is that against the investment that they make, the company issues certain securities, either in the form of equity shares or preference shares or CCDs for that matter, right? Now, when that happens, the investor is seeking certain rights in the company. That could be in the form of certain kind of veto rights, so that whenever company makes any decisions on certain matters, the expectation is that the founder is supposed to take investor consent on those matters. Another thing could be sharing information on a periodical basis. There are certain obligations which are there on the founder per se, what they can do, what they cannot do. So something on those lines, there is a consolidated document which is built around these subject matters. And the expectation is that the company and the promoters are supposed to abide by that particular document. And therefore, the very important document that the founder should read, understand, comprehend what's there in it, understand the implications of it, understand what the market norms are, what is generally acceptable in the market, so that they're not giving into anything and everything just because there's money coming in from an investor. So the ramifications of it is something that a founder has to be cognizant of and accordingly sign off on that particular document. Because once you sign off on that, document technically becomes a Bible to follow. And that also becomes a precedent for the subsequent rounds of funding of the company. And that is something which is very important. Because that
So I
becomes
guess, Rohini, what you're trying to say is, I'm sorry I'm butting in, just for the listeners to get a little faster inroads. When an investor wants to invest in a company and there is a founder, there an investor, both of them would sign a document. A typical investor could be a VC fund, of a venture capital fund, or a PE fund,
yes.
or whoever. And when this investment is taking place, that's the time an agreement is entered into between the founder and the investors. And that document is typically called a shareholders agreement. Is that something, have I correctly stated what a SHA is?
Yes, you summarize it well. Each and every shareholder is supposed to sign off on that document.
Excellent. Now, today, what we are going to do, ladies and gentlemen, is that we are going to take up three key issues which are very critical to keep in mind when a shareholders agreement is being entered into. Upfront, what we propose to do, we would discuss the founder's rights and obligations. The founder himself or herself has built an organization, there could be rights and obligations. The founder would also may need to exit one day, today, tomorrow, day after, whenever. So how that exit rights or exit options could be tackled. And number three, the whole matter of governance. Now, there was a founder or there were founders. Now there are new shareholders who are coming in as investors. How will this new company be run, or the company be run under new shareholding structure? So we are going to focus on these three important issues. Of course, ladies and gentlemen, all the viewers here, happy to take questions. Please do type in as we go along, whatever questions you are having in your mind. And I'm sure Rohini would be attempting to answer them. So having said that, we will focus on the first one, which is the founder's obligations, rights and obligations. Now, in typical, when a company is getting investors, and we hear words of vesting rights, lock-in, non-compete clause. So there are several legal terms which are used often, and the investor or the founder is sometimes grappling with it. Could you kindly explain to us that what these terminologies means, vesting rights, lock-ins, non-compete clauses, and also when such an agreement is getting entered, what are the rights and obligations which the founder should be careful of while signing the SHA or the shareholders agreement? Over to you, Rohini.
Sure. Thanks, Robin, for that. So let me first pick up what a lock-in is, all right? The founders at the time of incorporation of the company, they obviously hold 100% of the shares, the initial subscribers who are also the promoters of the company. So a lock-in typically means that they are not supposed to sell their shares while an investor is invested. That's typically what a lock-in means. The idea being that the investor today is investing in the company bases the vision that the founder has for the company. And therefore, the expectation is that the founders are supposed to have skin in the game. And not that tomorrow when you are able to get an investors into the company, bump up the valuations of the company, and then go ahead and sell your stake at a higher valuation. That's not the idea. So the investors expect you to remain in the company, not just as founders, but also as a significant shareholder in the company. Therefore, the lock-in. They can't sell their shares for whatever reason. Having said that, we also, from a founder perspective, we understand because there are times when they have certain kind of estate, because of taxation reasons, they can't hold the shares. So for those bona fide taxation purposes, if they have to put those shares of theirs in a trust, in a family trust, we completely understand. And those are carve-outs that we do within the document from a founder perspective. Otherwise, if they want to sell their shares to anybody, the investor expects you to take their consent before you actually sell off those shares to anybody. All right. And a vesting. A vesting is typically means that it's actually to an investor comfort. Idea being that over a period of 4 to 5 years, your shares will vest. It could be either at 20% or 25%. It depends how you have negotiated with the investor folks. The reason why you have a vesting schedule is that, for instance, the exit is agreed that the founders will give an investor an exit within 5 years. So the idea is that the lock-in is for 5 years, and over a period of 5 years, there will be a vesting schedule that will take place, a vesting of shares. Now, vesting, what is mistakenly understood by the founder is that the investors take the shares and they keep giving the shares, their own shares, to the founder. That's not the idea. You as a founder continue to hold. For example, if you hold 80% of the shares, the idea is that you continue to hold. The share certificates still remain in your name. But contractually, you are agreeing that it is locked in, and on a year-on-year basis, the shares will vest in a particular percentage. Now, taking it forward, if you were to maybe exit at the end of 3 years, now the exit could be for a good reason or a bad reason. Let me differentiate that for you. A good reason or a good lever event is typically when there is any health condition or there's any family issue, or for amicably agreeable with the investor, the founder is leaving the company, which means in the horizon of 5 years, at the third year, the founder has taken an exit. Then what happens to the company? So the bad lever could be that there has been unfortunately some siphoning of funds, which is attributable to the founder's actions, or there has been some misconduct. There's any posh complaint which has led to an order against the particular founder. All of that is a bad lever, which technically means that the investor wants the founder to leave. So that's not a really good scenario to look at, but that is a scenario which sometimes do happen, in which case the founder is leaving the company for a bad reason. In which case, in a good lever and a bad lever, the treatment of shares is completely different. In case of a good lever, what essentially happens is that whatever shares has already vested in the founder in the first 3 years, the founder gets to keep it. The founder gets to keep it. And whatever is not vested, because there were 2 years remaining, but they couldn't complete. So those 2-year shares, the company will have to either buy it back, or there will have to be a new founder coming in who will take those shares. In case of a bad situation where the founder has to leave because of a misconduct, a bad leaver situation, the idea is that the founder has to lose the entire stake. Lose in the sense either the company will take it or it will be given to some incoming founder. All of this is typically done to safeguard the interest of the company. The idea is the show must go on, even if there is no founder or any one founder has left the company. So these are safeguards which are put in place to protect the company and its operations, and of course the investors' investment in the company. So it does literally put the company a little bit of a dilemma, but these are safeguards that you see today more often. From a founder perspective, what you can ensure is that you define the concept of good lever and the bad lever very well. you agree on a lock-in of typically between 3 to 5 years and agree to a vesting schedule. That will typically safeguard the interest of the founder while they still have skin in the game and they continue to be part of the company. But for any reason, if they were to leave, then how will their shares, their founder shares be treated will depend on the situation for which they're leaving the company.
So
It
at
is
this
very
stage, I have a quick
stringent. Sorry?
at this stage, I have a quick question
Yeah.
that I think you have very clearly mentioned the leaving of the company or continuing to be there. But there is a word which is called non-compete clause, which I think has to be discussed at around the same time. Would you kindly bring that into picture if you don't mind, please?
Yeah. So, while the expectation of an investor that while the founder is part of the company, they can't really be doing any other side hustle which is competing with the business. That is one. Non-compete technically also kicks in as a cooling off period once they have left the company. So that's typically 2 to 3 years. I would always say 2 years. 2 years from the time that they actually cease to be part of the company. They can't be part of any other entity which is in similar business. So that the other entity does not get the benefit of their knowledge, expertise. And this particular company, which they were previously part of, do not really lose out on that. Correct? So non-competers that the founder cannot at any given point in time during that cooling off period be associated as an employee, as a partner, as a director, as a mentor, in whatever position it could be, or as an advisor to any entity which is competing with this particular company. That's about it. So what
2 years you said.
what the founder can do is that the definition of business. See, competing with a business means what? That business needs to be defined very well. For example, in a SaaS company, that SaaS business has to be typically defined because the founder knows tech really well. I'm sure if he steps out, he'll probably do something in tech. But what tech, what SaaS is he part of today here has to be well defined so that tomorrow when he leaves the organization, he is not left high and dry that he cannot do anything that he actually knows.
When you say there is a 2 years non-compete, I thought 2 years is rather less. The investors puts in money. I ask the founder not to do the business which he has just sold, and 2 years just goes by. Can it be 10 years? Can it be 15 years? Legally possible to enhance it or not possible?
No, so you will typically see, so in case of a M&A acquisition, where there's a complete buyout of a company, maybe see between 3 to 5 years. In case of a private equity venture capital deal, you'll typically see it for 2 to 3 years after they have left the company. The reason being that the investors are still invested in the company and the business is still growing. But when you're actually acquiring the entire company, you'll probably have a larger cooling off period. Other reason why you can certainly agree to a 10 to 15-year-old, 20 to 15-year non-compete period, but it is not enforceable under law. There are various judgments to the effect that it is unconstitutional if it is not reasonable.
And is reasonable 2 years or 5 years or 3 years?
Again, it depends between 2 to 5 years.
Okay, fair. Excellent. So you have explained to us the founder's rights, obligations, how to handle when a founder is getting investors. Now let's focus on the exit. Now the founder wants to exit or may exit in the future. And there are two words which comes along, which is drag along and tag along. These are words which is really sounding very, very complicated. Could you kindly explain to us what is drag along, tag along means,
Right.
especially in the exit clauses?
Sure. So recently we did a deal for a logistics company, okay? And it was a Series B round. The promoter was smart enough in his initial rounds while we were there. We actually carved out a promoter liquidity basket, which technically means that after a particular time, the promoter can actually sell off that much stake in the company in the future rounds. That's basically a liquidity basket. You will typically see between 5 to 10%. 10% is a little too much, but yeah, 5 to 10% is what you see. In this case, it was 7%. What happened is in the series C round that I did for him, we actually managed to get the founder also an exit to the extent of 5%. The reason was that there was a basket which was agreed upon. Now, what's typically a tag along, right? The investor is expecting the promoter to stay in the business, hold the shares, not sell it off. But in the event the promoter really wants to exit, the expectation is that fair enough, the founder has found a buyer for his shares, and the third party buyer is willing to offer next price. He goes to the investor and says, I am getting an X price. Are you willing to buy? The investor says, no, I don't want to buy shares of yours. I don't want to increase my stake in the company. But the investor has the right to tag along with you. So for example, if the founder is taking an exit of about 2%, the expectation is that up to 2%, the investors internally amongst them can also sell their stake proportionately to the third party buyer. That's one way of securing a partial exit for your investors. That's a tag along, right?
I have a quick clarification to seek, Rohini. So the investor wants to sell 2% to a third party. There's a tag along right of the investor to sell 2%. But what if the buyer says, no, I don't want 2 plus 2 to 4%. I only want 2%. Then what happens? Will it become 1% plus 1%?
Yes, so that will get renegotiated. If the investor has exercised his or her tag along right, the idea is that the founder cannot sell without the investor having sold their stake. So, which means if the third party buyer has agreed to buy up to 2%, it will have to be proportionately shared between the founder and the investor.
Very well explained. Very well
Now,
explained.
drag along.
Go ahead. Yes.
Drag along is where there are a couple of reasons why an investor would practically exercise a drag along right. Okay. That is typically when the company is unable to secure an exit for the investors. See, we have to appreciate the fact that the investors have a fund life. Because I do a lot of fund setups, I understand that under the SEBI AIF regulations, fund regulations, there is a typical timeline of about 7 to 9 years that they have fund life for. They can't go beyond that. So which means if an investor has invested today and the company is supposed to give them an exit within 5 years and it's already 7 years and the fund life is 8 years, they have to secure an exit, else they will be in non-compliance of the SEBI regulation, which has hefty penalties. So then the investor is left with no option but to identify a buyer. Now the buyer would say, boss, I don't want only your stake, I want to acquire the entire company. It could be a strategic buyout. So then the investor says, fair enough, I will make everybody sell their shares. That is how the investor has the inherent right to drag all the other shareholders into a drag sale. What the founder has to ensure is that the terms of that drag sale, the price at which the investor is selling the shares is also applicable to them as well. So it shouldn't be that the investor is selling at Y while the founder is expected to sell at Y minus 10. No, it has to be same drag sale terms. See, at the point where an investor is unable to secure an exit, even after multiple rounds have taken place, in my mind, I always tell a founder, it's like a sinking ship. You might as well just hive it off. You sell it off. Otherwise, everybody will sink. Otherwise, practically an investor is never in a position to actually go out and secure a buyer for the company. They don't want to make that kind of an effort. But if they are left with no option but to do that, then they will have to do that. That's one scenario when the company and promoter are unable to give them an exit. Two is in case of an event of default, where there is a default at the company and founder's end, and it's not rectifiable and it's actually hampering the reputation of the investor and the company. The investor would like to take an exit ASAP, in which case the investor makes an attempt to get a buyer for the company to buy out the entire company. In which case, again, the founders cannot resist that. And therefore, an investor, the lead investor generally has a drag right. You typically see in a shareholders agreement, it is only the lead investor who has a drag right. Or if there are multiple lead investors who are holding similar stake, there will be a joint right or a majority investor concept. So it depends how you structure it, depending how your cap table looks like. But you'll always see a drag right with the major investor on the cap table. And it's actually in the interest of the company as well that a drag right exists.
And a founder wants to encash the valuation of an organization, of a company which he or she has created, and investors comes in. So when this happens, it is all hunky-dory. There is friendship between the founder and the investor. They all have good relationships. Now, shareholders agreement is all about writing a piece of document. Should something go wrong tomorrow, or should I be able to do something for which I need to think today? But when I have seen, or I feel that when a shareholders agreement happens, an investor comes in terms of exit rights, it is mostly in favor of the investor, and not in favor of the founder. Exit rights more in favor of investor than not in favor of the founder. Is that thinking correct, or it is incorrect?
Look, you and I am, and I'm sure you also do. I make investments in company. Obviously, today, as it stands, I have most of my investments in the listed market. When I invest, the intent is always that I want to get my returns, right? I don't make an investment so that the company grows and I don't care about my returns. So yes, in a way, exit is to secure the investment of the investor as much as the company, because if you're able to secure an exit for the investors, the company is also growing, which means the company is able to raise subsequent rounds to be able to secure an exit for the investors. But if the intent is that you get more and more investors, you bump up keep raising the valuation bar of the company, and the founders get an exit, that doesn't work. Therefore, in fact, there's a health tech company that I was a part of where we actually agreed that if and when the company achieves a particular valuation and is able to raise a round at a particular valuation, there was a threshold to that effect, a minimum threshold. This particular founder will be able to sell about 5% of his stake. And that happened. And along with the founder, some of the existing investors also took an exit. The idea, so the way you see it is that early stages, you keep raising rounds, you have investors on the cap table. By the time you reach a Series B, Series C round, you will see that there's a shift in the thought process. The shift is to the effect that the cap table has to be trimmed down, which means you reduce the number of people on the cap table. So if you have those VC folks, those micro VCs, etc., who have participated early on, the idea is that by Series B, you actually give them a fair exit. And then you have the larger folks come on the cap table. So that by the time you're at Series D round, your cap table is trimmed down. You don't have too many people on the cap table. So that is
when you say cap table, number of shareholders.
The shareholding pattern, yes, the capital structure of the company.
Wonderful.
Yeah.
We have understood Rohini very well. Of course, we will answer questions. I think there are several questions which are getting typed down in the chat box. That what are the rights and obligations of a founder? What are the exit possibilities? How do we structure it? Now, how do we run the company? Okay, now investors come, founder has perhaps diluted his or her shareholding. How do we run the company? What the board should look like? Should the founder have majority shareholding in the board, or do you have some rules to say based on this percentage of shareholding, so much board positions the investors can have? the basic question is, having the investors in, how the company should be run, and what are the clauses in shareholders agreement we should write down so that the future is protected.
So I tell my founders time and again, in each and every deal that I worked so far, that it is important that as long as they have skin in the game and they are part of the operations, and their expectation from the investor is that they are supposed to run the company, they should have maximum people on the on the board. And if at all that investor, that investor can maybe have one board seat on the board. That's all. Idea being that majority board seat is taken up by the founders. There cannot be a 2:2, like, one investor having two board seats and the promoters having two. Then there's a deadlock situation that comes up. And it's not really a good situation to have. Then obviously the investor asks is, why don't we go in for arbitration? If at all the deadlock arises, arbitration is expensive. We're trying to resolve a situation, anticipate a situation today that could arise and address it in the document today. That's our job. So as long as the expectation is that the founders are supposed to be controlling the operations, they should be controlling the board as well. So the next question is, how does a lead investor have some sort of control in the decisions that the company takes? That is where the concept of veto rights or a reserve matter right or an affirmative voting right, these are just synonyms to each other. You can call it whatever. There are protective provisions. These are just nomenclatures, but they all mean the same. The intent being that there's a laundry list of 10 items, which is agreed upon in the document, the shareholders agreement. The company cannot go ahead with executing those matters unless and until the lead investor has approved it, has given a go ahead, has given a green signal. That's the expectation. If the investor says, no, I don't think it makes sense for the company to take this step, the company cannot do it. What the company can do is have a conversation, have a discussion. But these matters that you find in the veto right list has to be those which are pertaining to strategy and not pertaining to the day-to-day operations of the company. So these veto rights typically are so that the investors have visibility of the company, but not like micromanaging or not like a CCTV on the founders. No, that's not the idea. If at any given point in time a founder thinks that that is where it's heading to, then it's time to take a pause, take a step back, have a conversation with the investor saying, this is I'm not comfortable with, please. We've had so many deals where we've had to sit across the table and have discussions for days and days to see, boss, this is not working out. For a fintech company, for instance, you can't tell them I can't take debt. What you can do is that maybe put a threshold saying beyond a particular amount, I won't take a debt unless and until you as an investor don't approve it. So there has to be monetary thresholds agreed upon. There has to be a business plan in place, and there could be carve-outs around it. But for instance, you can't have a right on matters which are pertaining to my day-to-day operations. Every day, if I'm onboarding a vendor or a customer, the expectation should not be that I go to the investor waiting for him to give me a consent, because then that's hampering my business. So that's veto rights. So give them a board seat. The first thing I always tell them is don't give a board seat, but give a board observer seat. A board observer versus a director on the board are two different things. Why so? A board observer is somebody who can just observe, can watch what's happening in the meeting. That's all. Cannot participate, cannot vote. So he or she knows what's happening at the board level. That's all. A board seat is where the director on the board has a right to vote on the matters, right? So the idea is first push for a board observer, but by and large, when you have a lead investor on the cap table over and above 7%, 7 to 15%, you'll always have somebody having a board seat. Whether or not they actually exercise that right is a different thing, but you'll always have them having a board seat. That's one. And with an expectation that there are some veto rights, some strategy related matters on which the investor has the right to participate. That's one way of looking at it. The other is where the the promoter is expected to share information with the investors on a periodical basis. Now, there are deals, I won't even take those names, but there are deals where the VCs actually expect them to share information on a day-to-day basis, daily, monthly, quarterly, half-yearly, annually. So then my point of contention there is, do you want the promoter to sit and make that information day on day basis and forget the business altogether? That's difficult. Firstly, until they actually reach a Series B round, the teams are smaller. They don't have bandwidth. Should they be using that bandwidth to doing business, or using that bandwidth to actually prepare this laundry list of information to be shared with the investors? So there are days when I actually negotiate with the investors on behalf of the company and founders to trim down that list of information that the company is supposed to share. Because if I don't share it periodically, then that could trigger a breach of my shareholders agreement, and that can have other ramifications. So transparency, I understand where the investor is coming from. Sharing information, we expect transparency and accountability. Great, I'm all for it. Transparency is good, but reporting burnout absolutely isn't. It's not good. It's not healthy for the company. It's not healthy for the founders. So we have to arrive at a situation which is favorable for the company and the founders, as well as something which is acceptable to the investor, because I understand where the investor comes from, because they have an IC, an investment committee whose expectation is that every portfolio company should do XYZ things. I completely get it. But there has to be a balance which we have to draw in all of this. So that's something where I believe board and governance is something which can be balanced out.
So if I have to take the learnings from you, that I would guess the number of board seats should be in odd numbers, should not be even numbers, 3, 5, 7. So
Yes.
somebody has the majority.
Yes.
If it is 4, then it could be 2:2. If it is 6, 3:3. But what you're saying, okay, if there are 7 board members, then at least make 4 in favor of somebody. That somebody, something needs to be thought through. That's one takeaway. The second takeaway is whoever is going to run the company in terms of strategy should have the majority board members. So the board members' majority should be one of the group who are going to run the strategy. It could be the investors, or it could be the founders. And the third takeaway I can understand is that instead of board seat, you can actually sometimes give an observer seat. Yes. Which essentially means a board member can vote in board meetings, an observer cannot. So if there is a majority thing or something needs to be approved, an observer cannot vote for or against. So that's a nice little escape clause. So Rohini, you have really, really explained, but questions are coming in by the dozens. One question, perhaps it is rather simple, that is there a standard shareholders template, agreement template? So is there something, can you go to the Google auntie and say, okay, now give me the shareholders template? Is this something which works, or no, that doesn't work at all?
Look, I've actually worked on a couple of US deals, Now, US actually has a format that they have in place in the US. And by and large, every company, every law firm follows the same format. Unfortunately, we don't have a similar concept in India. Okay, so therefore, you will see a lot of different formats of SHA floating around. Also, in my view, that's not really healthy to have a format in place. I'll tell you why. Not because I want law firms to make money. No. The idea is that when I do a seed round and vis-a-vis when I do a Series D round, the SHAs are vastly different. Also, it not only depends on the round size, but it depends on the investors who are investing. If I have a friends and family folks investing, they will not ask for any rights. They don't really care about drag. They don't care about tag, nothing. But a PVC firm will always ask for it. So therefore, because of the round size, the nature of the round, the nature of the investors coming, the SHAs shape up accordingly. So therefore, there are no formats in place that you see.
So what you are saying, no, there are no formats. Case-to-case basis is what needs to be written down. One question is that how can the founders don't end up something which will restrict the founder tomorrow? Is there any one or two ideas you can say, okay, this is what you should take care? I know you have stated a lot of things today, but everything is hunky-dory today, who knows tomorrow?
Yes.
How can you safeguard the founder's interest? If the founder wants to grow, founder wants to exit, founder wants to do himself or herself, he or she got a good idea, founder wants to take it on. And what do you think about it?
Yeah. Look, I always tell, a point of negotiation is always that the SHA, which captures certain set of obligations and certain kind of undertaking from the company and the founders, the underlying intent is that such obligations are there to ensure commitment from the founders. But at no given point in time, it should actually create or give a sense of imprisonment to a founder. It shouldn't restrict them completely. There has to be some room for them to actually do something else. They're also individuals. So there has to be some room for that. For instance, after 3-4 years, if the founder thinks that the company is running on its own and his or her role is actually very limited, and therefore they want to step out and do something more or do something else because they have a brilliant idea which they want to probably execute, the investors need to be reasonable enough to let that founder take an exit. And for whatever number of years that the founder has actually put in, they should be remunerated enough. All those things have to be envisaged and put in the document today. The expectation cannot be, so I'll tell you where the founder's intent usually is, or at least today's founders have become very, very smart, but at least probably a few years back. Founders would just sign on the dotted lines because today they're very well committed, 100% they're committed. But we don't know how things pan out. So we have to anticipate those scenarios and today provide for appropriate carve-outs. For instance, what happens if the founder exits the company after X number of years? What happens to his shares? Does he get to keep it? Does he not get to keep it? If he's wanting to do some other business, there has to be some provision in the document permitting him to do that because it's anyway unconstitutional. But let's just put that in the document today that he can do something else over and above thing. Other than that, today, if you see, largely a lot of founders are also mentors, advisors to other companies, other startups. They should be permitted to do that. So there was a coffee chain company that I actually, I was helping them close around from a large VC. And one of the founders is a very reputed guy in the market and is a mentor to a lot of companies. The SHA straight jacket said that he cannot do anything, absolutely nothing except for that copy business. We had to have a conversation to say this gentleman has a background, has something which he's been doing till date. You can't restrict him. What we can do is that take a commitment from him that while he's doing XYZ, he also remains committed to the coffee business. So those are things which are to be discussed, not just discussed, not like a friendly handshake alone, but has to be appropriately carved out in the SHA. So I think it's all about envisaging and anticipating what could happen, what cannot happen, and accordingly provide for necessary provisions in the document.
Wonderful. One of the listener, I think Kushal Kumar, is asking, what are those three main critical points? Can I mention in one line? I would do it on behalf of Rohini now. The first point is rights and obligations of the founder. The second one is exit clauses. And the third one is governance, how do you run the company? So these are the three most important clauses or critical points which we discussed today. We are still discussing. There is one listener who wants to say that is this SHA, the shareholders agreement between the investor and the founder, is it something like a marriage? It is like a marriage, and marriage guidelines are similar. Um, Rather than taking a legal answer to that from Rohini, I think Shivam Jha said that. My quick answer to that is yes, it is. Any M&A, any acquisition, any founder-investor relationships is like a marriage. The relationship is always a give and take. Both sides need to give and both sides need to take. It is not one side affair. The moment it becomes a one side, which happens sometimes in marriages, if the marriages functions very well, when both there is love and affection from both the sides, M&As or investments are no difference. There is one question from Shivam again. He's saying that, does Rohini, do you have an example or a story to say that in spite of the shareholders agreement, but things did not work out well because there were a lot of details, and sometimes the devil is in the details, and things went right south. Do you have an experience or example to say where there was a SHA, but still the relationship did not work?
Yes, yes. Oh, quite a few of them. I can actually go on. So this was around for a FMCG company, and they raised multiple rounds. Started off with friends and family, and subsequently a very well-known angel investor from the industry who had invested very significant stake, and the founders didn't seem to really have a counsel on board. And today, so they did come to me after the issue actually cropped up, because there were times when the company needed capital, either in the form of debt or equity, and the investor refused to give consent. Because these are strategy related matters, the investor actually blocked that round and said nothing doing. There's no need to do a debt. There was a strategic alliance that they tried building with one of the platforms like Zepto. Again, got knocked off because the investors had nothing to do. There's no need to do that. I don't think it makes sense. Now, they came to us after all these issues happened, and I looked at the SHA. And trust me, the SHA was extremely exhaustive to have captured everything under the sun. There was no room for the founders to actually wiggle out of the entire deal. They could not do anything. Now, when I asked them, do you know what you signed up for? They said, yeah, I mean, we read it. We thought it's standard. We thought it was standard. So that's a problem. Now, then we tried having a conversation with the investor and said, let's sit across the table and discuss, because look, either you let them raise capital or the company is going down the drain. The ship is sinking. Your share certificates, your shares that you hold in the company, and so does the founders, it'll all be a piece of paper. So we are fine with that. We are fine. I mean, your investment will go to dooms. So let's have a conversation. You know what I got to know? Obviously, because I was not really part of the company for a long time, I just got in probably last year. I realized that the founders have taken decisions on strategic matters without having consulted the investor in the past. The founders, the company has not shared information till date. They forgot about it. They forgot that they had to share some information. They forgot there were obligations on them to approach the investor, send out notices for general meeting, board meeting to the investor. They completely missed it out. And today, as it stands, there is a deadlock because the investor says, you never kept me informed. You never abided by what's there in the shareholders agreement. The founder says, yeah, I forgot, but okay, the company has to run. Let's do something about it. The founder says, now rectify everything. Now you give me all the information about the company, then we'll see where to take it. So to answer your question, yes, even after having an exhaustive SHA in place, there are issues that crop up. I will tell you typically where it comes from. It stems from the fact that there is no communication between the company and the investor before signing off on the SHA, before taking the investment. It's all hunky-dory, like you rightly said, Robin. Everybody is very happy with each other and they want to go ahead. The execution is a problem. Execution at both ends.
In addition to that, I want to also add, Rohini, and for all my viewers today, that things go well with the businesses performing well. If the business is not performing well as per expectations, so things are not doing well in financial performance, that's where the problem happens. So, taking Rohini's point, keep the communication going with the investor. That's true for your lenders also. If you are borrowing from the bank or a financial institution, please keep your data, please keep your information being shared with them. Same for investors who are equity shareholders. Keep information going with them. And beware. If the business is running well, everything will be fine. If the business is not doing well, God help. There are some quick questions coming in, Rohini, and we are now running out of time, maybe a minute or two, but quick answers if you can give. Should the shareholders agreement also include ESG clauses? Should the shareholders agreement include ESG clauses?
So,
Quick answer to that because there are
yes,
some quick questions, please.
yes, there should be, because today each and every fund, so to say, have ESG guidelines to follow. And the expectation from their LPs, their investors, their own investors, is that the portfolio company should be ESG compliant. So you will see a lot of investors today, every second investor asking you to be ESG compliant, depending on the business that you're in.
Another quick question is that in case of startups or whatever, a company which is doing rounds, round one, round two, round three, every time the SHA needs to be restructured, redealt with, or one continuous format will hold true. I guess the first one is right. Go ahead.
Yes, so no, so the SHA formats will undergo a change up until your Series A round. There will be a drastic change in the SHA. From Series A round, you will see that pre-Series A, Series A round, you will see that the same SHA follows. There'll just be a change, addition, deletion of the investors. And of course, the framework of how the rights flow between or are shared between the investors gets carved out, gets trimmed down in the SHA. But yes, from a first round to a Series A round, you will see a significant change in the SHA round by round basis.
Wonderful. There was a question which is stating that at an early stage, the founders have enough leverage to negotiate their clauses, or should they focus more on getting the deal closed? I would guess this is more a business question than a legal question. The business answer, which I can give, that if the founder is looking for money and he or she has no choice, I presume for him or her, deal closing is more important. But if the founder is not hanking for money or asking for more money and he can or she can wait, then I think it's good to have a nice little SHA so that tomorrow gets better. Any quick answer to that, Rohini? We have just about a minute left.
Yeah, so I think it depends when you're raising the capital. See, if you have much bargaining power, so if you're anticipating that you need to raise money or you need to have money at the end of 18 months, by 18 months, that's your long stop. Idea is that today you should start getting on the road, doing road shows, approaching investors. But if maybe you approach investors just 2 months back, you have literally very less time to actually close your cap round because you need money ASAP. So it literally depends on your ask for money. When is it? So timing is very important when you're raising capital.
Rohini, you were outstanding. I think you answered almost all the questions. I quickly went through the chat box. I think in some form or the other, it seems that we have been able to answer all the questions. If I have to summarize, in short, in 30 seconds, a shareholders agreement is an agreement which is entered into when an investor comes in and the founder is diluting his or her holding. That's the time when we should think of the future. And three critical areas are: what are the rights and obligations of the founder because he or she built the business? Number two, how does the founder exit or go out of business or continue to be in the business tomorrow if he wants to do so? How is it that he or she will be running the business in the future? Technically called exit clauses. And number three, more importantly, once the investor comes in, the founder is still there with lower shareholding, I guess. How will the company be run? What are the board rules? How many board positions should be there? My dear viewers, a company is run by the board of directors. It's a majority opinion which goes through, and therefore it's like a democracy. Therefore, whoever has the majority share board position would ultimately run the organization. So, ladies and gentlemen, it was a wonderful, wonderful talking to all of you. It is absolutely 58 minutes of hardcore shareholders agreement discussions. Rohini, as usual, is always, always fantastic. Rohini, would you like to just summarize in a sentence or two what my listeners should know?
Yeah, I think thank you, Robin, for summarizing it so well. But just to keep it brief, I think before you sign off on a SHA, just go through what the expectations of the investor is, because what they communicate perhaps is not all that which is coming in the term sheet gets elaborated in the SHA. So the SHA needs to be literally looked at carefully and know what your obligations are before you sign off on the dotted line. Look at it practically, look at it from a business standpoint, and that's how you should probably get some help before you sign off on that.
Wonderful, wonderful. Thank you so very much, my dear listeners, my dear participants. Thank you, ladies and gentlemen. Thank you so very much.
Thank
Bye-bye.
you. Good evening. Bye.